Several investors have called out the Federal Reserve on its recent actions that have heavily affected the markets. One of these investors is Cathie Wood. Join us in today's video as we hear Cathie Wood's take on the Federal Reserve's actions. Stick around until the end to learn important details on inflation and deflation. CEO and Chief Investment Officer of ARK Invest, Cathie Wood, emphasized her belief that periods of instability promote innovation. However, despite being an innovation strategy, her company's ARK Innovation ETF has not fared well recently. Cathie Wood, a prominent macroeconomic analyst, recently stated that she now fears deflation more than inflation, pointing to economic red flags such as waning consumer confidence, record stockpiles, and recent changes in the fixed income market. Cathie Wood claims that the inflation data from the Personal Consumption Expenditure Price Index and the Consumer Price Index are irrelevant and out of date. The forward-looking statistics, on the other hand, present a different scenario according to Cathie. It is Cathie Wood's opinion that the Federal Reserve has not yet caught up on the key market signals, including consumer confidence, growing credit default swaps, and a flat yield curve, which she feels indicate that we are in a precarious position. Additionally, Cathie Wood referred to the Consumer Sentiment Index calculated by the University of Michigan, which has lately reached an all-time low. Using inflation and consumer mood as a gauge, she predicts that the circulation of money may begin to drop, which is an indication of deflation.
Using the CPI as its guide, the Fed is making a big mistake. There's already a lot of deflation in the economy. And one of the reasons the deflation is accelerating here is because the Fed has shocked the system. We have gone from 0.25% in the Fed funds rate to 1.75% in the span of 3 months. That's a 7-fold increase. We've never seen that before. Now, I know a lot of critics are suggesting, oh, what are you talking about? From such a low level. You can't make a comparison to the early 80s when interest rates went from 10, Fed funds rate went from 10 to 20%. Which was only a 2-fold increase. You just can't make that comparison. Well, yes, I can. I can make that comparison up 5-fold very quickly. I think the Fed has panicked, and it's causing the economy a lot of problems. As I mentioned before, though, it's becoming obvious now, and I do believe they will change their tune with a few more reports. So what are the deflationary signals we're seeing out there? Well, one of the most obvious, but one that very few people mention, or maybe they don't monitor, are credit default swaps, CDSs. Now, this is the price of insurance against bankruptcy. And so when the price of this insurance goes up dramatically in a short period of time, I certainly take note. So the 5-year CDX, as measured by Markit, M-A-R-K-I-T, has gone from 50 to 100 year to date. And for JP Morgan, so a money center bank, it has gone from 48 to 102. So JP Morgan's credit default swaps have gone up more than the market's average. That's very interesting, and we're trying to figure out what is that all about. We know that JP Morgan is a fortress. It's not going bankrupt, but there are some investors concerned, or concerned that there might be something systemic going on, and so why not take out the insurance? Now, 102 is quite a bit below 08-09. We were at 239 then, and below COVID, 172. But it is above where we reached in the fourth quarter of 2018, 80. That was a vicious market downturn in only a quarter, one quarter's time. So I think it was from September to December. So this doubling in credit default swaps for the market's average and JP Morgan has us asking questions. Is there something systemic out there? Our guess is that if there is, it has to do with the reach for yield that we saw during the last few years as interest rates went effectively to zero on the short end and as low as 0.5% for the 10-year Treasury bond yield during the coronavirus. Now, reaching for yield, if on top there's leverage, could be a problem. Now, one of the reasons we don't think this is going to be a problem is because of what happened a little more than a year ago with the Archegos blow-up. Apparently, one bank didn't know the amount of leverage that Archegos had taken on. And this was true across the banking system. And so that's how that situation became so leveraged. I think risk officers are now looking for excessive leverage. And so we would be surprised if there is going to be a systemic risk, but we do want to note that the concern is out there and it is elevated. Interestingly, and speaking of JP Morgan, the head or the chief investment officer of its asset management unit, by the last name Michelle, came out yesterday, and I found it difficult to believe, given that he's right in the middle of the bank. But he basically said, the Fed had waited too long, and now it's going to have to work that much harder to get inflation under control. And I think he's ignoring an incredible number of signals, the first of which I've just shared with you, credit default swaps. The other one is the yield curve. And I know I've focused on the yield curve on this webinar many times. It is flat. It did go negative for a time in April. We've never, in post-World War II experience, seen the yield curve invert without a recession soon thereafter. And we think we're in a recession and that it happened as the yield curve was inverting, which was a quick response. Now, what I'd like to feature this time is the history of yield curves. And when we've moved into crises, we've seen monetary and fiscal authorities, easing quite significantly, trying to stimulate the economy, acting as a counterbalance. And often, and certainly since the early 90s, when this has happened, the yield curve has steepened to the 250 to 300 basis point range. So that's 2.5 to 3% range. And what this means is long-term interest rates are 2.5 to 3 percentage points higher than short-term interest rates. And the reason for that is investors begin to worry about the inflationary ramifications of fiscal and monetary stimulus. So 250 to 300 is where I thought we went in the middle of the COVID crisis, because we have never seen monetary and fiscal policies as stimulative as we did during the coronavirus, when we thought we could enter a depression, just the economy, global economy shutting down. So I was surprised as we looked back to see that the yield curve steepened only to 150 basis points, or 1.5%. What does that mean? What does that mean? I think it confirms that the bond market, in its wisdom, was beginning to worry about deflationary undercurrents. And so to see it flatten so quickly and having only gotten to 150 basis points is very interesting. And so what are some of these? Oh, there's one other note. The last time we saw the yield curve after a recession or during a recession getting only to 150 basis points was in the early 80s. Now, inflation and interest rates were raging at the time in the double digits, and the Fed had gotten very, very tough. The dollar was rising fairly dramatically. And what happened was the Louvre Accord was when Treasury authorities from around the world all got together, including the U.S. Treasury Secretary, and said, okay, we've got to supply the world with dollars. We'll sell dollars and buy back the other currencies. And that's what happened. So the dollar back then was very deflationary, especially for emerging markets who had a lot of debt that was denominated in dollars. So their currencies were falling apart, but their debt was denominated in dollars. And so it was becoming much more expensive for them to service that debt. We may have a similar situation now. Perhaps the dollar going up, and it's up more than 10% over the last year, which is a massive move if you're in emerging markets and your currencies are plunging, as many are. So there is a likelihood that this is saying more about the deflationary undercurrents in the rest of the world, much like it did in the early 80s.
What do you guys think of Cathie's analysis? Do you agree that the Fed is to blame for this upcoming downturn? Share your thoughts in the comment section down below. If you enjoyed this video, please like and subscribe, and we'll see you in the next one.